Most people think of investing in the scope of stocks, bonds, and cash, but there are some other strategies out there that offer an interesting approach. Some generate higher income, some can reduce the volatility in your account, and some can offer access to investments that many people don't immediately consider. They're called alternatives, and we're going to discuss them next. Hello, welcome back to Wealth Wednesday, our bi-weekly show that will help you make better decisions about money in your life. If you'd like to learn more about us, please visit us on the web at cfswv.com. Also, you can find out past episodes of our YouTube channel. That's at Commonwealth Financial. Alternatives are a different frontier for us. They've been around for a while, but until last April, when Commonwealth created its own RIA, we had a very limited access to these types of products. I'm joined today by Daniel Spurgeon, a CFP pro here in Parkersburg, and he joins us to discuss these unique assets. Daniel, what can you tell us about these type of investments?
Sure. Well, there's for starters, there's a few main types, but this is by no means all types of quote unquote alternatives. But again, you've got private credits, private equities, real estate, infrastructure, hedge funds, market neutral, long short, etc. You could even argue that gold, copper, precious metals would be a type of alternative. The main case for alternatives that you hit on in the introduction is typically to reduce volatility, either on a systematic basis or unsystematic basis. Improve income, absolute return in some cases, and then obviously potential for more attractive returns, especially than fixed income bonds.
So the important thing to remember here is these are not intended to be a silver bullet that solves all the problems in the investment world. Many of these investments are designed to be purchased and held for a number of years, just like we tend to think stocks are meant to be bought and held for quite some time. The big difference here is liquidity is often restricted many times to once per quarter, or sometimes even a 2 or 3 year commitment. So that has to be a factor in your decision. But the idea behind the limited liquidity is that you should be paid for giving up the access to the funds. So now these investments are also not without risk. Like anything, strategies can work well until they don't. And with liquidity issues, it can be hard to sell out of them quickly. Daniel, a traditional approach would be in a portfolio would be to be 60% stock, 40% bonds. How are we looking at these alternatives to enhance or augment a portfolio?
Sure. If you look back a couple of years when interest rates were pretty much zero, it was very difficult to generate positive returns or even a decent income stream in traditional bonds or fixed income. That was very, very challenging during those times. So there's been a lot of academic challenge and industry challenge to the classic 60-40 retirement portfolio, 60% stocks, 40% bonds. And looking to add non-correlated assets like alternatives. And again, very, very broad, overarching statement, but depending on the type of investment strategy would make sense. But looking at changing that allocation from a 60-40 to like a 60-20-20 or a 50-30-20 with equity, fixed income, and alternatives. So again, the whole hope for this is to drive more diversification into the portfolio by adding truly non-correlated assets to the stock market, which is another issue we've had with fixed income and the two major drops we've had since 2020, COVID, and 2022. We've seen bonds act relatively highly correlated to stocks and not provide any kind of a buffer or risk management. And then obviously the whole goal there would also be by adding alternatives, either improvement of income, improvement of total return, or again, reduce fluctuation in the market. We don't expect equity-like returns in alternatives. So that's something that, again, you just said it earlier, it's not a silver bullet. This is not a never fails type of investment. There's nothing out there like that exists. But the long-term goal is again, to dampen volatility, smoothen the ride out, and ideally get nicer returns than fixed income and similar returns potentially to equities, but with a lower standard deviation profile.
Right. And I hate to be kind of the negative on here, but this is an asset class that has risk, just like every other asset class does. And a key thing when you're doing this or considering these alternatives for your portfolio is position sizing. You have to make sure that you have some other resources to tap into when you are allocating to an asset class like this because the accessibility just isn't quite there. Stocks and bonds, easily liquid. You can have money within a week very easily, or sooner even many times. The other side of this is asset location. And by asset location is what kind of accounts are these types of positions held in. They're not necessarily the most tax efficient type investments that you can find. So they'll generate, in many cases, a lot of ordinary income that if you're already in a higher tax bracket can actually make your tax situation a little bit worse. So those are all factors that are going to figure into how alternatives could be used in your accounts on that. Daniel, this is deep, a very, very deep topic. And I know you've been having a lot of conversations with folks. What are some final thoughts that you can share with us today?
Yeah. Again, we hit on this about every call. The purpose for any investment recommendation has to line up with your goals and your timelines, which are established and defined through the financial planning process. So these are not a silver bullet, like you said, but they can be a really nice tool that over a long period of time can amplify returns and ideally simultaneously lower drawdown risk and lower volatility in the portfolio. So again, there's a lot with these. I mean, a lot. We could have a 20-minute, 30-minute call on each subset of investment structures that fall kind of under this large category or genre. Realistically, I would just have a conversation with us if you have additional questions. There are certain thresholds depending on the type of investment, whether when I say thresholds, income or net worth. So the SEC breaks people out into retail investors, accredited investors, and qualified purchasers. And depending on which threshold you or your family fall in or your business will open doors for you as to what types of investments that you can get into in this space. So again, I would say definitely if you have questions, reach out to us. And we're happy to dive further into the weeds as far as how this subset of investments may make sense for you.
It's certainly a worthwhile topic to explore when you have a chance. And if you would like to have more information about this, reach out to any one of our team members like Daniel, myself, or any of the other advisors on staff. And if you want to help locating those individuals, you can find them at cfswv.com. If you like this video, hit that thumbs up button and be sure to subscribe to our channel so you don't miss another episode of Wealth Wednesday. Thanks for watching. Have a great day.